Welcome to Safe, Simple Sound Tax Edition. I'm Alex, your host, and I'm joined by Sam, our tax expert, and Taylor, who asks the questions you might have on your mind. Together, we break down complex tax topics into clear, actionable insights. We use AI-enhanced voices to deliver consistent, high-quality content while keeping our focus on what matters most, helping you understand your taxes. In each episode, I'll guide our discussion, Sam will provide expert analysis, and Taylor will make sure we explain everything in plain English. We're here to make taxes approachable, whether you're filing a basic return or dealing with more complex situations. But before we dive in, a quick note. This podcast is for entertainment only and does not constitute tax, financial, legal, or professional advice. Tax decisions should always consider your personal circumstances, filing status, and specific situation. All tax amounts, thresholds, and deduction values mentioned are examples only. Tax numbers change annually, and you must use the current official values from irs.gov when preparing your returns. Be sure to consult a qualified tax professional before making any tax-related decisions. If you would like personalized guidance, you can reach out to us at safesimple.com/contact. Let's get started. Here at Safe Simple Sound, we want to empower you to seize financial control and understand the true cost of your decisions. And today's topic is a crucial piece of that puzzle: choosing the correct tax filing status. To help us navigate this often confusing landscape, we're diving deep into Chapter 2 from the IRS's Publication 17, all about filing status. This chapter is a goldmine of information for determining which of the 5 filing statuses — single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse — applies to you. One key takeaway from this chapter is the simple yet vital point. If more than one filing status applies to you, choose the one that gives you the lowest tax. Sounds obvious, right? But understanding how to figure that out is where things get interesting. We'll also be looking at how your marital status on the last day of the tax year is generally what determines your filing status for the whole year, with some very important exceptions. So, how will we break this down for you today? We've got 4 critical areas to cover. First, we're going to unravel some single filing status and marital status nuances, looking at how those year-end divorces can impact your taxes with Sarah and Mark, and what happens when a marriage is annulled, as we'll see with John and Jane. Next, we'll weigh the pros and cons of married filing jointly versus separately, making the right choice. We'll see how unequal income and deductions can impact your overall tax bill for David and Emily. Then we'll talk about protecting yourself from the potential financial fallout from a spouse hiding income or debt with Lisa and Tom's scenario. Finally, we'll discuss what happens when a spouse dies, and we'll review Robert's options and implications of Mary's death. After that, we'll move into head of household, navigating unmarried status and qualifying persons. Can you file as head of household even if you're still legally married, as we'll explore with Susan and Tom? And what if you're supporting a parent who doesn't live with you? We'll break that down with Michael. Finally, we'll wrap up with qualifying surviving spouse benefits and eligibility, where we'll consider how remarriage can affect your filing status, something Jane is considering. And we'll examine how a dependent child's income might change your eligibility for this valuable status, for example, with David's child and summer employment. So buckle up, everyone. We're about to unpack the often overlooked but vitally important topic of tax filing status, empowering you to make safe, simple, and sound financial choices. Let's get started. Let's start the show with this scenario. What happens when a couple gets divorced right at the end of the year? Let's imagine Sarah and Mark. They've been going through a divorce, and it finally gets finalized on December 30th, 2024. Sarah's confused because they were married for almost the entire year. She's wondering if they can still file as married filing jointly. Mark, on the other hand, is thinking about whether filing jointly might get them a better tax outcome, even though they're legally divorced. So, Sam, legally, where do Sarah and Mark stand in terms of filing status for 2024?
Well, Alex, this is a common point of confusion, and the IRS is actually quite clear on this. According to the IRS, if you are divorced under a final decree by the last day of the year, you are considered unmarried for the whole year. So even though Sarah and Mark were married for almost all of 2024, because their divorce was finalized on December 30th, they are considered unmarried for the entire tax year.
Wait, so even though they were married for 364 days, it's that one day that determines everything? That seems kind of harsh.
It does seem that way, Taylor. But that's the rule. They can't file jointly. Their options are single or if they qualify head of household.
Okay, so Sarah and Mark can't file jointly. What are the specific implications of that December 30th finalization date? What filing options are available to them based on that marital status?
Right, so practically speaking, they each have to file either as single, married, filing separately, or head of household if they meet those requirements. If either Sarah or Mark has a qualifying child living with them for more than half the year and they pay more than half the costs of keeping up the home, they might be able to file as head of household. But if not, they're looking at single or married filing separately.
This reminds me of a friend who rushed to get married on December 30th a few years ago so they could file jointly. It sounds like if they had waited just one more day, it would have completely changed their tax situation that year.
Exactly, Taylor. The timing of major life events can have a significant impact. And what about Mark's idea that filing jointly would somehow get them a better tax outcome despite the divorce? Is that even possible, Sam?
No, that's not possible in this situation. Once the divorce is final before the end of the year, the option to file jointly is simply off the table. There's no going back, regardless of what might have been more beneficial.
So even if they both agree that filing jointly would save them money, they're still legally obligated to file as single or married filing separately.
Correct. Their legal marital status on December 31st dictates their filing options. It's not about what's most convenient or even most beneficial from a tax perspective. It's about adhering to the IRS guidelines based on their legal status. The reference article also specifies that if you are divorced under a final decree by the last day of the year, you are considered unmarried for the whole year, and you can't use married filing jointly as your filing status.
Makes sense. So, what specific steps should Sarah and Mark take to ensure they're complying with tax laws given this late year divorce? What kind of documentation will they need?
First, they need to gather all the usual tax documents: W-2s, 1099s, records of any deductible expenses. But they also need to be prepared to prove their divorce decree if the IRS questions their filing status. It's also crucial they communicate and agree on who will claim any dependents, if applicable. Because even though they're divorced, only one of them can claim a child as a dependent.
So, if they have children, they need to figure out who's claiming them before they file, right?
Precisely. And that decision can have a ripple effect on other tax benefits like the child tax credit or the earned income credit. This can be especially tricky in divorce situations, and it's often spelled out in the divorce decree itself. They will want to reference IRS Publication 501, which discusses dependents, standard deductions, and filing information.
So, key takeaways here. A divorce finalized by December 31st means you're considered unmarried for the entire tax year. You can't file jointly, even if it seems like it would be more beneficial. And you need to ensure you have the proper documentation to support your filing status, especially the divorce decree.
Okay, so it really boils down to that one day. It makes me wonder if some couples deliberately delay or expedite their divorces based on the tax implications.
It certainly can be a factor, Taylor. People should make decisions that are in their best interest. If they are deciding to do this, it is important to consider all factors, consult a tax professional, and act accordingly.
Absolutely, a lot to think about. Thanks, Sam. Okay, that was really helpful. And for our listeners, if you're navigating a divorce and unsure about your filing status, please consult a qualified tax advisor for personalized guidance. Tax situations can become complex very quickly, especially after a divorce. In our last segment, we dissected the tricky situation of Sarah and Mark, who finalized their divorce late in the year and were unsure about their filing status. Turns out, since they were legally divorced on December 31st, they couldn't file jointly, regardless of how much of the year they were married. Now, let's dive into an even more unusual scenario. Imagine this. John and Jane have been happily filing jointly for the past 3 years, but this year, bam, their marriage is annulled. The court basically says the marriage was never valid in the first place. Talk about a tax headache. Taylor, Sam, what are your initial thoughts?
Oh, wow, that's rough. I'm guessing this throws everything they thought they knew about their taxes into complete chaos. So, Alex, you're saying they've been filing jointly for 3 years, and now the court is saying it was like it never happened. What are John and Jane's filing options now that their marriage is annulled?
Exactly, Taylor. It's as if the marriage was erased from the record. For tax purposes, the IRS treats an annulled marriage differently than a divorce. With a divorce, the marriage was valid up until the divorce decree. With an annulment, the IRS essentially rewinds time.
So, Sam, let's cut to the chase. What does this mean for John and Jane's filing status going forward?
Because the court decree of annulment holds that no valid marriage ever existed, John and Jane are considered unmarried for all tax years affected by the annulment, even those years where they filed jointly.
Okay, so if I understand correctly, even though they actually filed jointly for those years, the IRS now sees them as if they were single all along.
Precisely. The IRS doesn't recognize them as ever being married, at least for tax purposes, due to the annulment.
Which leads to our next question. How can they correct their previously filed joint returns? This sounds like a paperwork nightmare.
It does involve some work, but it's manageable. They'll need to amend those previous tax returns using Form 1040X, amended U.S. individual income tax return.
Form 1040X. Got it. So they have to go back and redo their taxes for the past 3 years, filing as single individuals. What if one of them benefited more from filing jointly? Are they just stuck with that now?
That's a valid point, Taylor. It's entirely possible that one or both of them will end up owing more in taxes after amending their returns. Filing jointly often offers benefits like higher standard deductions and more favorable tax brackets. Unfortunately, the annulment overrides those benefits retroactively.
So they need to refile as single, potentially owing more money. Is there a time limit on this? What is the statute of limitations for amending their past returns?
Generally, for claiming a refund, you must file Form 1040-X within 3 years after the date you filed your original return, or within 2 years after the date you paid the tax, whichever is later.
Okay, so 3 years from when they filed, not from when the annulment was granted.
Correct. And it's important to note that if they filed early, say on March 1st, their return is considered filed on the due date, which is generally April 15th. However, if they got an extension and filed later, the actual date the IRS received it becomes the filing date.
That's a crucial detail. So, to recap, John and Jane's marriage was annulled, meaning the IRS now sees them as never having been married. They need to amend their past 3 years of tax returns using Form 1040X, filing as single individuals. They have a limited time frame to do this, generally 3 years from the original filing date or 2 years from when they paid the tax, whichever is later. And, unfortunately, they might end up owing more taxes as a result. Sam, anything we are missing?
One thing to note is that if John and Jane lived in a community property state during those years, things could get even more complicated. Community property states have special rules about how income and expenses are divided between spouses, even when filing separately.
Community property, that's where assets acquired during the marriage are owned equally, right? So they'd have to figure out how to split everything retroactively, even income they already reported jointly. Ugh, this sounds like a total headache.
Exactly. Publication 555 from the IRS covers community property and can provide some guidance, but consulting a tax professional in that situation would be highly recommended.
Absolutely. This is a prime example of how a life event can drastically impact your tax situation, even retroactively. Taylor, any final thoughts?
Just that I really feel for John and Jane. This whole scenario highlights the importance of keeping good records and understanding how different legal situations can affect your taxes. And definitely consult a professional when things get this complicated.
Couldn't agree more. This is a complex situation, and professional guidance is key. Now we're going to shift gears and tackle another common question. What happens when one spouse earns significantly more and has far more deductions than the other? This often creates a bit of a tax puzzle.
A tax puzzle is right. It seems like it would be obvious which way to file, but I bet it's not.
Exactly. Let's consider David and Emily. David earns $150,000 and Emily earns it. David also has quite a few itemized deductions. Think mortgage interest and charitable donations, while Emily has very few. They're wondering whether it makes more sense to file jointly or separately. So, Sam, to kick us off, what are the potential tax benefits and drawbacks of filing jointly versus separately for David and Emily?
Okay, so the initial reaction might be that with David's higher income and deductions, filing separately would make sense. However, that's not always the case. Filing jointly generally simplifies things and often leads to a lower overall tax liability because it unlocks certain deductions and credits that are only available to those filing jointly.
Wait, so even though David has all these deductions, filing separately might hurt them?
Precisely. The tax code is full of these little quirks. For example, as the reference article states, if they filed separately, they might run into a situation where the capital loss deduction limit is only $1,500, whereas it would be $3,000 on a joint return.
That's a great point, Sam. And to make it even clearer for our listeners, filing jointly often gives you a higher standard deduction. Think of the standard deduction as a base amount that everyone gets to deduct from their income, regardless of itemized deductions. Filing separately often reduces this standard deduction.
So, if I understand correctly, even if David itemizes, Emily wouldn't be able to take the standard deduction if they file separately.
That's absolutely correct, Taylor. If one spouse itemizes, the other spouse must also itemize when filing separately. This can really hurt if Emily's itemized deductions are less than the standard deduction she would have gotten filing jointly.
Okay, so it sounds like filing jointly unlocks certain benefits. But what about the flip side? What are the drawbacks?
The main drawback of filing jointly is joint liability. Both David and Emily are responsible for the accuracy of the entire tax return and for paying the entire tax bill. So if David were to, say, accidentally or intentionally underreport income, Emily is equally on the hook for that.
Oh, wow, that's a really important point. What if Emily suspects David isn't being entirely honest about his income?
That's a tricky situation, and we'll explore it more in our next scenario. But for now, let's assume both are being honest.
Fair enough. So, Sam, how do David and Emily's respective incomes and deductions impact their overall tax liability under each filing status? This is a crucial point, I think.
Right? With David's higher income, they'll likely benefit from using the joint tax brackets, which are wider than the married filing separately brackets. This means a lower percentage of their combined income will be taxed at higher rates. Also, David's itemized deductions can offset a larger portion of their combined income, reducing their overall tax burden.
So it's about maximizing those deductions across both incomes.
Exactly. Now, the amount that David can deduct for itemized deductions will not be limited by filing separately. When filing jointly, the income can be combined to allow for even more itemized deductions that could potentially lower their tax liability.
Okay, so it's a balancing act. Wider tax brackets and potentially higher deductions filing jointly versus individual liability and potentially limited deductions filing separately. So, Taylor, based on what we've discussed, what do you think? Which filing status will likely result in a lower combined tax bill for David and Emily?
It sounds like, even though David has significantly more income and deductions, they should probably start by calculating their taxes as if they were filing jointly. The wider tax brackets and the ability to maximize David's deductions against their combined income seem like they would provide a bigger advantage.
I agree. It's almost always worthwhile to start with a joint return calculation. Then they need to compare that to the married filing separately scenario to see which gives the best result.
Great. So, Sam, any other factors that David and Emily should consider?
Absolutely. They need to look at any potential limitations on deductions or credits that might arise from filing separately. For example, the reference article mentions that you can't take the education credits, like the American Opportunity Credit or Lifetime Learning Credit, if you file separately.
Oh, that's huge. What if Emily is paying student loan interest?
Good catch, Taylor. They also can't take the deduction for student loan interest if filing separately. These things can really add up.
Okay, this has been incredibly helpful. So, to summarize the key takeaways, filing jointly usually unlocks more tax benefits like wider tax brackets and a higher standard deduction, but it also means joint liability. Filing separately can limit deductions and credits. In situations like David and Emily's, where there's unequal income and significant deductions for one spouse, it's crucial to calculate taxes both ways to see which filing status results in the lowest combined tax bill.
And to remember potential limitations on certain credits and deductions based on filing status.
Excellent point, Taylor. So, for our listeners, here's your call to action. Use a tax preparation software or consult with a tax professional to compare your tax liabilities under both filing statuses. Don't just assume one is better than the other. Run the numbers. Now, building on that concern about honesty in a marriage, in our next segment, we'll look at a much trickier situation. What happens when one spouse suspects the other is hiding income or has significant debt? It's a situation no one wants to be in, but it's important to know your options. Now, we're moving into a situation that's unfortunately a little more fraught with risk.
Oh, great, something juicy.
Well, not exactly juicy, but definitely something people need to be aware of. We're diving into a scenario where trust is strained. Let's call it that.
Sounds like my kind of fun.
In this scenario, Lisa suspects her husband Tom isn't reporting all of his income and has significant debt. She's understandably concerned about being held liable for his potential tax evasion or financial obligations if they file jointly.
Yikes. Okay, that's a whole different level of complexity. So if they file jointly, is Lisa automatically on the hook for everything?
Good question, Taylor. That's exactly what we're going to unpack. Sam, can you shed some light on Lisa's potential liabilities if she files jointly with Tom, especially considering her suspicions?
Absolutely. Filing jointly means you're both signing on the dotted line, Alex. The IRS views a joint return as a single economic unit. The reference article states both of you may be held responsible, jointly and individually, for the tax and any interest or penalty due on your joint return.
So, jointly and individually, that's a key point. Even if the unreported income or debt is solely Tom's, the IRS can come after Lisa for the full amount.
That seems incredibly unfair, even if she had no clue.
Exactly. This is a critical thing for people to understand. Ignorance isn't necessarily bliss in the eyes of the IRS.
So, with that in mind, Sam, what protection does filing separately afford Lisa in this situation?
Filing separately creates a clear line of demarcation. Lisa would report only her own income, deductions, and credits. She's only responsible for the tax liability generated from her return. The reference article mentioned you may want to file separately if you believe your spouse isn't reporting all of their income, or you don't want to be responsible for any taxes due if your spouse doesn't have enough tax withheld or doesn't pay enough estimated tax.
So if Tom underreports his income and they file separately, the IRS can only pursue him for the discrepancy.
Precisely. Lisa's assets are shielded, at least in theory, from Tom's tax liabilities.
It's a way of saying, I'm only responsible for my own actions. However, remember that filing separately often means losing out on certain tax benefits. But in a case like Lisa's, peace of mind might be worth more than a potentially lower tax bill.
This reminds me a bit of what we talked about with David and Emily and running the numbers. It seems like you really need to weigh the risks versus the rewards here, but with a much bigger potential downside.
Exactly, Taylor. It's risk management, plain and simple. Now, what happens if Lisa unknowingly files a joint return with incorrect information and later discovers Tom's deception?
Then she can explore innocent spouse relief. The IRS recognizes that sometimes people are genuinely unaware of their spouse's financial misdeeds. Publication 971 explains these kinds of relief and who may qualify for them.
And what does innocent spouse relief actually do?
It can relieve Lisa from the responsibility of paying the additional tax, penalties, and interest that result from Tom's errors on the joint return. There are actually 3 types of relief available: innocent spouse relief, separation of liability, and equitable relief.
Separation of liability. That sounds interesting.
Separation of liability is available only to joint filers whose spouse has died or who are divorced, legally separated, or haven't lived together for the 12 months ending on the date the election for this relief is filed.
So, what factors does the IRS consider when deciding whether to grant innocent spouse relief?
A few things. Did Lisa know or have reason to know about the understatement of tax? Did Lisa benefit significantly, directly or indirectly, from the understatement? And it boils down to whether it's fair to hold Lisa liable, considering all the facts and circumstances.
Okay, so it's not a guaranteed escape hatch. The IRS is going to dig in and investigate.
Correct. And the burden of proof is on Lisa to demonstrate that she qualifies for the relief. She'd need to file Form 8857, Request for Innocent Spouse Relief.
This all sounds incredibly stressful.
It does, and it highlights the importance of open communication and transparency in a marriage, especially when it comes to finances.
Absolutely. It's a good reminder that financial infidelity can have serious consequences, not just for the relationship, but also for your tax obligations.
Absolutely.
So, let's recap the key takeaways from this segment. First, filing jointly makes you jointly and individually liable for all taxes, penalties, and interest, even if the issue stems solely from your spouse's actions. Second, filing separately protects you from your spouse's tax liabilities, but you might miss out on certain tax benefits. Third, if you unknowingly file a joint return with errors, you might be eligible for innocent spouse relief, but it's not a slam dunk.
And if you suspect any funny business, get professional advice before you file.
Couldn't agree more, Taylor. That brings us to the end of this segment. Remember, folks, if you're in a situation like Lisa's, it's crucial to consider filing separately and consult with a tax attorney or CPA to discuss your specific circumstances and potential liabilities. Okay, in the previous segment, we were talking about situations where one spouse might be hiding income or have a lot of debt, and the protections you get from filing separately. It's a tough situation, but sometimes necessary. On the other end of the spectrum, we have situations dealing with the loss of a spouse, which is also really difficult.
Absolutely, Alex. Going through a loss is one thing, but then having to figure out taxes on top of that feels incredibly daunting.
It does. Which brings us to our next scenario. Let's talk about Robert. His wife, Mary, sadly passed away in July of 2024. Now, Robert's wondering what his tax filing options are, not just for 2024, but also going forward, especially since he has a young child to care for.
Oh, that's heartbreaking. I can't imagine dealing with all of that at once.
Exactly. So, Sam, let's start with the basics. Can Robert file jointly with Mary for the 2024 tax year?
Yes, he can. According to the IRS, if your spouse dies during the year and you don't remarry before the end of the tax year, you're considered married for the entire year for filing status purposes. This means Robert can file a joint return with Mary for 2024, reporting their combined income and deductions.
Okay, that makes sense. So even though Mary passed away mid-year, for tax purposes, they were married the whole year.
Precisely. It's also worth noting, Alex, that even if Mary had passed away in early 2025 before Robert filed their 2024 taxes, he could still file jointly for 2024.
That's good to know. So what about after 2024? Is Robert eligible for what's called qualifying surviving spouse status? I've heard that term thrown around.
Yes, he might be. The qualifying surviving spouse status is a special provision that allows a surviving spouse with a dependent child to use the married filing jointly tax rates and the highest standard deduction for 2 years following the year of their spouse's death.
So, in Robert's case, if Mary died in 2024, he could potentially use that status for 2025 and 2026. It's like getting the benefits of filing jointly, even though he's no longer married.
Exactly. It gives some financial breathing room during a difficult time.
But what are the specific requirements for claiming the status, Sam, and how long can Robert use it?
Okay, there are several key requirements. First, Robert must have been eligible to file a joint return with Mary in the year she died. That's 2024 in this scenario. Second, he must not remarry before the end of the year he's claiming the qualifying surviving spouse status. So if Robert remarries in 2025, he loses the benefit for that year and beyond.
Remarriage disqualifies him. Got it. What else?
Third, and this is crucial because Robert has a young child, he must have a child or stepchild who qualifies as his dependent.
And that child needs to live with him, right?
Yes, the child must live in Robert's home for the entire year, except for temporary absences like school or vacation. And finally, Robert must pay more than half the cost of keeping up the home.
So things like rent or mortgage, utilities, property taxes, the essentials.
Exactly. And to reiterate, this qualifying surviving spouse status is only available for the 2 years following the year of death. So, as we said earlier, potentially 2025 and 2026 for Robert.
Okay, so just to recap, Mary died in 2024. Robert can file jointly with her for 2024. Then, if he meets all those requirements, doesn't remarry, has a dependent child living with him, and pays for more than half the household expenses, he can file as a qualifying surviving spouse for 2025 and 2026. After that, what happens?
After the 2-year period, Robert may be eligible to file as head of household if he continues to meet those requirements, especially the one about having a qualifying child living with him and paying more than half the household expenses.
So the qualifying surviving spouse status is like a temporary bridge to potentially filing as head of household. It sounds like it gives people a bit of time to adjust.
Precisely, Alex. It's a transitional benefit to ease the tax burden during a difficult period.
This reminds me a little bit of what we were discussing with the single filing status, particularly regarding the nuances of dependence. We talked about how certain criteria had to be met for someone to be considered your dependent. Does that come into play here?
Absolutely, Taylor. The child must meet the criteria to be Robert's dependent. So things like the child's age, residency, and whether the child provides more than half of their own support are all relevant.
And if the child earns too much or gets married and files jointly, it could jeopardize Robert's ability to claim either qualifying surviving spouse or head of household status down the line.
Exactly. It's a chain reaction.
This has been incredibly helpful, Sam. Thank you for clarifying those nuances.
Yes, thank you. It's good to know there are some provisions to help surviving spouses, but it's also important to be aware of all the requirements.
Absolutely. So, to summarize the key takeaways, if your spouse dies during the year, you can file jointly for that year. You may then be eligible for qualifying surviving spouse status for the next 2 years, provided you meet specific requirements, including having a dependent child and not remarrying. After that, head of household status might be an option. For our listeners, we recommend checking the IRS guidelines to determine eligibility requirements for both married filing jointly and qualifying surviving spouse. Given the complexities surrounding estate matters and tax implications after the loss of a spouse, consulting a tax professional is always a wise decision. In previous segment, we were diving into situations where a spouse passes away during the tax year. Now we're shifting gears to a different but equally complex family situation: separation without divorce.
Oh, this sounds like it could get tricky fast.
It definitely can, Taylor. Let's consider Susan and Tom. They're married, but they've been living apart for the past 8 months of 2024. Susan is carrying the financial load, paying more than half the costs to keep up a home for their child. Tom, on the other hand, hasn't lived in the house since May. So here's the big question. In this scenario, can Susan file as head of household, even though she's still legally married?
That's a great question, because I would assume married means you have to file jointly or separately.
The key here, Taylor, is a concept the IRS calls being considered unmarried. Just because you are legally married doesn't automatically disqualify you from head of household status.
Okay, considered unmarried. So it's like a loophole, but a legal one?
More like a specific set of criteria. According to the IRS, to file as head of household when you're technically married, you need to meet several tests. First, you have to file a separate return. This includes filing as married, filing separately, single, or head of household. Second, you must have paid more than half the cost of keeping up your home for the tax year. This includes things like rent or mortgage, utilities, and property taxes.
Right? And remember that Worksheet 2.1 in the reference article provides a checklist to determine if you're paying more than half the costs. Property taxes, mortgage interest, rent, utilities, repairs, insurance, and even food eaten in the home all count. But things like clothing, education, and vacations, those don't get factored in.
Okay, that makes sense. So Susan is covering the bills, she's filing separately. What else is she up against?
The next big one is that her spouse, Tom, didn't live in her home during the last 6 months of the tax year. So from July 1st onward, Tom couldn't have been living there, even temporarily. This is where Tom's move-out date being in May becomes important, meaning he satisfies that part of the test. Also, the home needs to be the main home for Susan's child for more than half the year.
Got it. So it's not just about having a child, but the child has to live with you. But what if the kid goes to summer camp for 2 months? Does that break the more than half the year rule?
That's a great question, Taylor. The IRS considers temporary absences for things like school, illness, business, or even vacation as still living at home. The key is that it's reasonable to assume the person will return home and you continue to maintain the home during the absence.
And Susan also needs to be able to claim the child as a dependent. There's a slight twist here. Even if Susan can't claim the child as a dependent owned only because Tom, the non-custodial parent, is claiming the child under the rules for divorced or separated parents, Susan can still file as head of household.
Wow, that's good to know. It's like the IRS is trying to be fair to the parent who's actually providing the home and care, even if the other parent gets the dependency exemption. So let's say Tom moved out in August instead of May. That would disqualify Susan from claiming head of household.
Exactly. The requirement is that Tom didn't live in the house during the last 6 months of the tax year. Since August would only be 4 months away from the end of the year, Susan wouldn't be able to file as head of household.
Okay, this is making sense. It's all about meeting those specific tests. So to recap, Susan and Tom are married but living apart. Susan pays more than half the costs of keeping up the home for their child, who lives with her. Tom hasn't lived there for more than 6 months, and Susan could claim the child as a dependent. If all of those conditions are met, Susan can file as head of household, even though she's still married.
Absolutely, Taylor. You nailed it. So the key takeaway here is don't assume that your legal marital status is the only factor determining your filing options. Situations like separation can open the door to head of household status, but it's crucial to meet all the IRS requirements. For our listeners, be sure to review the requirements for being considered unmarried for tax purposes and make sure you meet all the criteria. Now, what if Susan wasn't separated from Tom but was supporting her mother? Let's see how head of household status applies when supporting a dependent parent. Let's dive into our next scenario. We have Michael, a single guy who pays over half the cost of his mother's care in a nursing home. She qualifies as his dependent, but Michael lives in his own apartment. So the big question is, can Michael file as head of household even though his mother isn't living with him?
Ooh, this is interesting. It seems like a common situation, especially with elderly parents needing care.
It is indeed. Sam, can Michael claim head of household status in this situation?
Absolutely, Alex. This is a key exception to the living with you rule for head of household. Generally, to qualify, the qualifying person needs to live with you for more than half the year. However, the IRS makes an exception for dependent parents.
Okay, so the mother not living with him doesn't automatically disqualify him. Good to know. But what are the exact requirements he needs to meet then? Because there's always a catch, right?
Precisely, Taylor. While the co-residency requirement is waived, several other conditions must be satisfied. First and foremost, Michael must be able to claim his mother as a dependent. This means she must meet the dependent tests, the gross income test, the support test, and the citizenship or residency test.
Just to recap for our listeners, the support test means Michael has to provide more than half of his mother's total support. The gross income test means his mother's gross income has to be below a certain threshold. For 2024, it's $5,470. And the citizenship or residency test simply means she needs to be a U.S. citizen, U.S. national, or a resident of the U.S., Canada, or Mexico. Is that correct, Sam?
That's a perfect summary, Alex.
And since she's in a nursing home, I'm assuming that counts as her main home for tax purposes, even though Michael has his own place?
Exactly. Now, here's the caveat. Michael has to pay more than half the cost of keeping up a home that was the main home for the entire year for his parent. In this case, if Michael pays over half the cost of keeping his mother in the nursing home or home for the elderly, that counts as paying more than half of the cost of keeping up your parent's main home.
Okay, so there is a key difference in the rules. If the qualifying person is anyone other than a parent, that person must live with you. For a parent, they do not, but you must still pay more than half the cost of keeping up their home or nursing home.
Okay, that makes sense. So it's not just about providing support, but specifically paying for the upkeep of their residence. What kind of expenses are we talking about here? Does it include just the nursing home fees or other things as well?
The cost of keeping up a home includes things like rent or mortgage interest, property taxes, insurance, repairs, utilities, and even food eaten in the home. For someone in a nursing home, the nursing home fees would likely cover most of these. But it's important to consider additional expenses Michael might be paying, such as medical bills not covered by insurance, clothing, or other personal needs. These all factor into the overall support calculation to determine if Michael provides more than half.
This is where meticulous record keeping becomes essential. What kind of documentation would Michael need to prove he's providing more than half of his mother's support, Sam?
Excellent point, Alex. Michael should keep detailed records of all expenses he pays on behalf of his mother. This includes receipts for nursing home payments, medical bills, prescriptions, clothing, and any other expenses related to her care and upkeep. Bank statements showing the transfers of money to the nursing home or directly for his mother's expenses are also crucial. Furthermore, a written statement outlining all the support he provides and an estimate of her total support from all sources can be useful.
So essentially treat it like building a case to prove you're providing the majority of the support. That makes sense. So if Michael's mom had some income of her own, like Social Security, that would factor into the calculation of her total support, and he'd need to prove his contribution exceeds hers, right?
Exactly. Social Security benefits, pension income, or any other income his mother receives counts towards her own support. Michael needs to demonstrate that his contributions exceed all other sources of support combined.
Okay, so key takeaways here. Even though Michael's mom doesn't live with him, he can still file as head of household if he meets the dependency requirements and pays more than half the cost of keeping up her home. In this case, her nursing home. He needs to keep detailed records of all expenses to prove he's providing more than half of her total support.
This reminds me a bit of when we talked about claiming a child as a dependent and how important it is to track all those expenses. It sounds like the same principle applies here, just with a different qualifying person.
Precisely, Taylor. The devil is always in the details when it comes to taxes.
One more point to consider, Alex. If Michael has siblings and they collectively support their mother, it's crucial to determine who is claiming her as a dependent. If no single person provides more than half of her support, they might be able to use a multiple support agreement, but that would disqualify Michael from claiming head of household status.
That's a critical point, Sam. The multiple support agreement is a whole different ballgame, and it's important to remember that it prevents anyone from claiming head of household status based on that dependent.
Wow, this is so helpful to walk through. I can see how easily someone could miss a crucial detail and end up filing incorrectly.
Absolutely. So, for our listeners, if you're in a similar situation to Michael, our call to action is this: document everything. All expenses related to your parents' care, and make sure they meet the IRS's definition of a dependent. Don't leave anything to chance. In one of our previous last segments, we discussed a scenario where Robert's wife passed away, and we explored his filing options for the year of her death and subsequent years, focusing on the benefits of the qualifying surviving spouse status. Now, let's flip the script slightly and consider what happens when a surviving spouse is considering remarriage. Today, we're going to dive into a scenario about Jane. Her husband passed away in 2022, and she has a dependent child living with her. She's planning to remarry in December 2024 and is wondering how this affects her filing status for 2024 and the years to come. Sam, can you walk us through the tax implications here? Taylor, I'm sure you'll have some great questions as we go along.
Absolutely, Alex. This is a common situation, and it's important to understand the timing. Let's start with Jane's filing status for 2024.
Exactly. What filing status can Jane use for 2024?
For 2024, because Jane's husband died in 2022, and she has a dependent child living with her, she is still eligible to file as a qualifying surviving spouse. The qualifying surviving spouse status is available for 2 years following the year of death.
So, just to clarify, even though she's getting remarried in December of 2024, it doesn't affect her filing status for that year.
That's correct, Taylor. The key here is that she has not remarried before the end of 2024. According to the IRS, to qualify as a qualifying surviving spouse, you must not have remarried before the end of the tax year in question. So she gets the benefit for one last year.
That's a great clarification, Sam. It really hinges on that specific timeline. So, what happens after December 2024 when she does remarry? How will her remarriage impact her eligibility for the qualifying surviving spouse status and beyond?
Excellent question, Alex. Once Jane remarries, she is no longer eligible for the qualifying surviving spouse status. The benefits of that status are specifically designed for those who have not remarried.
Okay, so she loses that benefit. But what are her options then? I mean, she's going from a pretty advantageous filing status to what?
That leads us to Alex's third question. After she remarries, the most likely filing status for Jane will be married filing jointly with her new spouse. This assumes, of course, that both Jane and her new spouse agree to file jointly. She could also choose to file as married filing separately, but as we have discussed previously, that status often results in a higher tax liability due to various limitations on deductions and credits.
Right. We touched on the drawbacks of married filing separately in our discussion about unequal income and deductions between spouses. Remember, Taylor, how certain deductions and credits are significantly reduced or even eliminated when filing separately?
Yes, I remember. So generally, married filing jointly would be the way to go unless there are very specific reasons not to, like concerns about the new spouse's financial history or potential tax liabilities.
Precisely, Taylor. And it is worth noting that filing jointly means that both Jane and her new spouse are jointly and individually responsible for the accuracy of the tax return and any taxes owed.
Okay, so to recap, Jane can file as qualifying surviving spouse for 2024. Remarriage in December 2024 doesn't affect that, but starting in 2025, she'll likely file as married filing jointly with her new spouse unless specific circumstances warrant filing separately.
This reminds me of when we discussed head of household status. Could she file as head of household instead of married filing jointly if certain circumstances arose?
That's an insightful question, Taylor. Typically, once married, filing as head of household is not an option unless she and her new spouse live apart and she meets the requirements to be considered unmarried for tax purposes, which we covered in the previous segment when we discussed situations for Susan and Tom. This includes living apart for the last 6 months of the year, providing more than half the cost of keeping up her home, and having her child live with her for more than half the year. But in most remarriage situations, this wouldn't apply.
Okay, that makes sense. So the key takeaway here is understanding the timing of the remarriage and its impact on the qualifying surviving spouse status, and then evaluating the pros and cons of filing jointly versus separately with the new spouse.
Exactly. And don't forget that once Jane is married, she may be able to claim her new spouse as a dependent, assuming he meets the requirements, which can provide additional tax benefits.
Great point, Sam. This is a complex area and it's crucial to consider all the angles. So for our listeners, the call to action here is understand the timing of your remarriage and how it affects your filing options and tax benefits. Be aware of how you can claim the new spouse as a dependent when married. And as always, consult with a qualified tax professional for personalized advice tailored to your specific situation. Now that we've covered remarriage considerations, let's move on to our next scenario: dependent child's income and filing status. We'll explore how a child's income can affect a surviving parent's eligibility for the qualifying surviving spouse status. So here's the scenario. David lost his wife in 2023. He has a child living with him whom he claims is a dependent. However, this child earned $6,000 from a summer job and is now wondering if they should file their own tax return. Let's unpack this. Sam, the big question is, does the child's income affect David's ability to file as a qualifying surviving spouse?
That's a great question, Alex. The key here is to remember the eligibility rules for the qualifying surviving spouse status. One requirement is that David must have a child or stepchild whom he can claim as a dependent or could claim as a dependent except for a few specific reasons.
So it's not just about having a child, but whether you can claim them as a dependent. This reminds me of when we talked about dependency exemptions a while back.
Exactly, Taylor. The reference article specifies those exceptions. A child's income exceeding a certain threshold is one, which we'll touch on, filing a joint return is another, and the parent being claimed as a dependent on someone else's return is the third. For 2024, if David's child's gross income is $5,050 or more, David can still potentially claim qualifying surviving spouse. This is because his dependent earned over $5,050.
Okay, so the $6,000 the child earned doesn't automatically disqualify David, which leads us to our next question. Can David's child even file their own tax return if David is claiming them as a dependent?
Yes, Alex, the child can file their own tax return. Earning income gives them a reason to file, especially if they had taxes withheld from their paycheck. They might be due a refund. The fact that David is claiming them as a dependent doesn't prevent the child from filing.
So, the child files to get back any withheld taxes, and David can still claim the qualifying surviving spouse status, even though the child filed.
That's right, Taylor, as long as the child doesn't file a joint return. That's the kicker.
Aha! So what are the implications then, Sam, if David's child does file a joint return?
If David's child files a joint return, then David loses his eligibility for the qualifying surviving spouse status.
Wait, why is filing jointly such a big deal?
Because one of the requirements for the qualifying surviving spouse status is that the surviving parent must be able to claim the child as a dependent or could claim as a dependent except that the child filed a joint return, the child had gross income of $5,050 or more, or you could be claimed as a dependent on someone else's return. Filing jointly automatically makes the child ineligible to be claimed as a dependent in most cases.
So to recap, David's child earning $6,000 by itself doesn't stop David from claiming qualifying surviving spouse because David could claim them except that the child had gross income of $5,050 or more. But if that child files a joint return, David is out of luck for the qualifying surviving spouse status.
Okay, I think I get it. So David and his child need to weigh the pros and cons. The child might want to file to get a refund, but they need to understand that filing jointly could cost David a lot more in taxes due to losing the qualifying surviving spouse status. It's a big decision.
Precisely, Taylor. It's a balancing act, and sometimes the best course of action isn't immediately obvious.
This is a great example of how seemingly simple situations can have complex tax implications. To help our listeners navigate these complexities, we recommend this call to action. The key takeaway here is to carefully consider whether a dependent child should file a tax return, especially if it could impact your eligibility for certain tax benefits like the qualifying surviving spouse status. You might want to run some tax projections before making any decisions. And that brings us to the end of today's episode of Safe, Simple, Sound. We covered a lot of ground, unpacking the complexities of filing statuses and really emphasizing how crucial it is to pick the right one to minimize your tax liability. We explored the 5 statuses, but we really dove into how marital status on the last day of the year affects all those decisions, drawing heavily from Chapter 2 of IRS Publication 17. I think one of the most impactful discussions we had was around Lisa and Tom. The idea that you can be held responsible for your spouse's tax missteps is a scary one and really highlights the importance of understanding your rights and considering filing separately if you have concerns. And certainly, Robert and Mary's scenario showed how, even in times of great sadness, careful planning and understanding the qualifying surviving spouse status can really help. Thank you for joining me today on Safe, Simple, Sound Tax Edition. Check out the show notes for all mentioned resources, including IRS sources and helpful tools. If you found value in this episode, please leave a review and share it with someone looking to better understand their financial choices. This is Alex, wishing you safe, simple, and sound financial journeys.